Hello. So a viewer of the channel asked me to make a video about C Limited, a company that I was actually not aware of. But I do love it when viewers ask me to make videos about specific companies or any specific topics, because I love investing and I love also helping. And if I can, give my 2 cents here, I'm more than willing to, and I love doing so. So if you have any questions, any videos that you'd like me to make and talk about, just let me know. And if you are new to this channel, please like the video if you like it, if you like what you are watching, and subscribe. There will be more. I'd love to see you also on our Discord channel. You can find the link in the description below. We're talking about all sorts of things investing. All right, so what is C Limited about? So I had to take a little bit of a closer look at the company, see what they are about, and this description kind of gives you an idea. It engages in the digital entertainment, e-commerce, and digital financial service businesses in Southeast Asia, Latin America, rest of Asia, and internationally. I saw that they have a digital entertainment platform that they call the Garena, and that's for users accessing mobile and PC online games, as well as esports operations and things of that sort, user chats, online forums. So they are basically doing entertainment, like in the gaming space, and communication services is their sector. Now, let's take a little bit of a closer look and see the overview of the company, see what they are doing in terms of the stock price, which was skyrocketing for a while, like a couple of years. And then in the last 3 months, where a lot of stocks have achieved nothing really and have actually fallen down in very weird territory. Same thing happened with C Limited here, went from almost 370 here to 155 right now. It did go up 7% in the last trading session. Now, the company's outstanding shares are sitting at 561 million shares over here. And the interesting thing to note is that the company has actually issued a lot of shares over here, and it looks like they're issuing shares at regular intervals, which is not great to see because they are diluting us if we're investors. And if we have invested over here, we have been diluted. Over here, we have been even more diluted. Okay, so the thing that I don't like seeing, the first thing that I really don't like seeing here is the fact that they don't have a PE, which pretty much means that they're not making money. So let's take a little bit of a closer look at their financials, see what they are actually doing. The income statement shows us what kind of income the company is making and what is their bottom line, what is their net income after all the operations happen. Now, the thing that I liked about the company is the fact that they are massively increasing the year-over-year growth of revenue and gross profit. There's a huge increase here. And revenues are massively important for companies because they show investors that they have the ability to sell. And this is extremely important because companies that can sell can do well in the future for the most part. The bad thing that I really disliked here in terms of the income statement is the fact that with all this increasing revenue, and that's a large sample, like they started with 400 million almost, and they are now sitting at 8.3 billion, and that's from 2017 till now. It's almost 5 years. And you will see that the net income of the company over here is actually decreasing instead of increasing, and it's actually in the negative. And so that's something that I typically don't like to see unless we're talking about a growth company and it happens for a few years, maybe a couple of years, and then I'm seeing signs of a reversal. That's what I want to say. But here I'm seeing signs of an increasing decline here, and I don't like to see that at all. Like I want to see at some point the company starting to at least lower its loss here. This is some pretty steep loss happening. All right, what about the balance sheet here? And you could ask yourself, how do you expect a positive balance sheet if the company is losing so much money? And the answer is stockholders are paying for it, or debt is paying for it. There's two things. There is nothing else here. So we will actually break it down, see what is paying for this company. So the total assets of the company keep increasing, and I told you why this happens. And total equity also from 400 million to 7.8 right now. What are the total liabilities of the company? They are sitting at 10.7, almost 11 billion here. But let's now take a look at the cash flow statement, which is very crucial because it shows us how the company actually makes its balance sheet. So the cash from operations is marginally positive. Actually, it's okay. It's getting more and more positive, so that's good to see. So the company is making some money from operations. Cash from investing, the company is still investing. Other investment activities here and a little bit of capital expenditures, market securities, normal stuff. But here I would expect massively positive values. And of course, look at that, 1.6, 500, 2.5, 3.7, 9.9. And when you're seeing positive values in financing cash flow, this means that the company is actually getting debt or selling stock, their own stock, the company stock. So it means that they issue stock. Both situations are not great for investors unless the company uses that debt or that extra funding from selling shares to increase their bottom line. But are they increasing their bottom line? So it's been 5 years and their net income is decreasing. And bottom line, by the way, is the net income of the company that we examined earlier. So the company is actually issuing a lot of debt. Look at that, 600 million, 500, 1.1, 1.1, this is actually the same. And also issuing common stock, 960, this is almost zero, 1.5 billion of shares, 2.9. So at some point, they thought that this was back in 2019 and 2020. And if we take a look at what was happening at the stock price 2019 and 20, look at that. It's increasing and increasing and increasing. And so the company thought that they could actually capitalize on that trend and sell more stock because it had a higher value here. And so they could finance their operations. They could actually get that as an extra cash injection. And that's what they did. However, that's not great for investors, of course, because it dilutes them. So now there are more shares available. And, your shares, the shares that you bought back in 2018, let's just say, are now worth less because there are more shares in the market. So that's not great. And this is how they're financing themselves for the most part, debt and stockholders' equity, as you can see. Free cash flow was negative and now it's marginally positive. But how positive is it? You'll see that if we even exclude these 3 years here, they're making about 300 million in free cash flow over here. And let's use a calculator here. This is like 0.3 billion. We give it a multiple of 20 for the company. This is $6 billion, and that's the projected market cap for a 20 times free cash flow. But the current market cap is sitting at 87 billion. And if we do 87 divided by 6, which is our projected market cap for a 20 times multiple of the free cash flow, we're getting a 14.5 as a multiple. So this looks to be almost 15 times more expensive than the one we would like it to be. Again, if we take the free cash flow multiple of 20 as our measure here. And that actually means that if we divide 155 and if we divide that with to 14.5, we get 10.68. And this would be the accepted price that we would be willing to spend, the amount of money that we would be willing to spend per share if we are going with the 20 times free cash flow multiple. And again, of course, this is a very, very conservative approach. But even if I give it a little bit of a margin here, maybe I can say that I'm willing to buy it for $13 or $15 or even $20 if I'm feeling lucratively. The company is actually trading at $155. That's way off. And you may be thinking to yourself, so when do I buy this stock? I mean, it will never be $10, right? Well, you never know, really. Probably not, but you never really know. The thing is, are you willing to massively overpay just because you want to own it? Or maybe there are better investments and you may not even want to touch this one for a while. So yeah, this is how I would feel about this company. It seems very expensive to me, and I couldn't see myself getting into it. And again, the fact that they are not making money in their bottom line scares me a lot. And so, it's really scary to enter a company of that sort where I don't know how much money they're gonna be making in the future, and I have already overpaid. And the thing is, you may be thinking, if you take a look at the overview, that it has fallen off a cliff and it has fallen a lot, so it's cheap. But it doesn't work that way. Cheap in the stock market can get cheaper. And this is what often happens. So don't think that because it's like 50% down, it's cheap. That's not how we define cheap in the stock market. We define cheap when the company is making $100 and you buy it for $50 or $80. That's cheap. But if a company is making minus 10 and you buy it for 50, just because it was 100 2 months ago, that's not cheap. That's still expensive. So bear that in mind. Of course, it's your decision in the very end. But this is how I feel about this specific company and stock price. I mean, the company could be great, but the stock price, it's just too expensive for me. Hope that helps a little bit. And again, I have to thank the viewer that actually asked me to make the video. I hope it gives them some information and adds a little bit to what they were thinking about the company. And thanks a lot again. Thank you. And thank you guys for watching this. And if you did enjoy, please take a look at this video that I made earlier. And it is about Amazon and its recent blowout in earnings. So thanks for watching again, and I'll see you in the next one. Bye bye.